Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and our blog. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We're not responsible for trading decisions taken by anyone. This is not an offer to buy or sell any derivative. And today is September 17th, 2019. And Andy Lebow, we're in the middle of a very fluid situation with what's going on in Saudi Arabia. There's supposed to be a press conference at 1 o'clock Eastern Time today. Why don't you catch us up on what's going on?
Okay, good morning, Jim, and hello to all our listeners. It's been a pretty hectic 3 or 4 days in the oil markets, and Jim, I think both of us know why this this happened over the weekend, because I think we had a meeting at global headquarters in Connecticut, and both of us said, "Boy, the oil market is really, it's been trading in this range, and guaranteed, right?
Yes.
Things have gotten outright boring." I said, "No, I'm bored. I'm not bored. It wasn't.
Yes.
Crude could be very interesting, and 2 or 3 days later, it became much more interesting than it had over the past few weeks, when we're just range bound. So we sit here Tuesday at noon, and as our listeners know, the Saudis lost 5.7 million barrels per day of crude export capacity or crude production. Probably lost another 1 million barrels a day of refinery capacity owing to the natural gas issues that they had on the attack. The U.S. is claiming that the attack came from Iran. The Saudis originally said it was the Houthi rebels from Yemen. And right now we don't really have clarification on where this attack came from, but it's looking more and more like it could have been Iran. No word from the Saudis. It did look like this could be a major issue, and it still could be, Jim. I mean, this is still could be, but the Saudis have come out to the press and said, Reuters in particular, and have said that they think they can get back to full capacity within a few weeks. Other analysts have been saying it may take months to get production up to 5.7, but obviously the Saudis have scrambled. And what a market, right, Jim?
Yeah, I think Andy, we've seen the market react today. It's around it's a little after 12 noon, moving sharply lower on all this. I guess the fact that the stories that a Saudi spokesperson said that stuff was coming back, just as you mentioned, so maybe faster than what people had anticipated. But there's uncertainty, as you also mentioned, around what they say and what will actually happen. There's uncertainty around retaliation, and there's uncertainty around if the attacks happen again. So, what do you think about going forward?
That's a lot on your. That's a lot to put on my plate, right at the.
Right. So they're going to.
You're right. There's still a lot of uncertainty in the market. I mean, obviously, if they are able to get this production up quickly, in the next couple of weeks, we're not going to. The market is not going to suffer all that much of a shortfall owing to the loss of these barrels. refined products we'll talk about a little bit later that could have a bigger impact. But what they say and what actually happens, as you mentioned, Jim, could be, could be radically different, as we've seen in U.S. infrastructure.
Exactly.
When there's been damage via hurricanes or accidents, it always seems to take much longer than what they say. And right now they're singing a pretty optimistic tune. They do have backup, but these are pretty sophisticated. This is a sophisticated plant, and whether it's 2 or 3 weeks, I don't know. I mean, that seems pretty quick to me.
Yeah, and the fact that they're saying they're coming back quickly might take SPR releases off the table for the near term. I mean, you could find a situation where you start drifting higher, or maybe it takes longer than expected, so we don't get a SPR release because the news is comes out in drips and drabs, rather than if they came out today and said we're not going to be back for months, then you'd get an SPR release.
Yeah, and that's and that's a key factor to the market. The President Trump was all over talking about an SPR release. The IEA has been pretty vociferous, saying that they do have emergency stocks, which they do. They have 2.2 billion barrels of crude oil and refined products around the world. Not only in the U.S. but in Europe and other strategic locations. So, I think that's definitely giving some comfort to the market is the IEA stockpiles. What's problematic, of course, is if these are down, if production's down, for any serious length of time, we really don't have a lot of spare capacity, which is clearly bullish for the market.
Yes.
Maybe we could see production increases out of, maybe Russia, maybe Iraq. The Saudis have some, they have the most spare capacity, which again, it's unclear what that's, how that's being organized right now. And of course, there's the neutral zone between Saudi and Kuwait, which is about 500 to 600,000 barrels a day. That's been in a dispute for it's years now. I mean,
Right.
That's been years.
Yeah.
But that's that's some spare capacity as well. And it isn't as though I know we're going to talk about this more at length. It isn't as though the U.S. producers can just turn on a switch and automatically provide hundreds of thousands of barrels at a moment's notice to the market. That's not the case. Although
That's what they could, Andy.
Jim, as we will discuss, they are due to increase production significantly between now and the end of the year. Anyway,
Right.
Saudi shortfall or not, those barrels are coming on.
Before we get into sort of the expected stock draws and builds, I just want to talk about something that we actually did see happen yesterday, and that is the bump up in implied vol. We talk about a risk premium on the price of oil due to what happened. You can see immediately the cost of options has gone up, and so we were. If I'm looking at November options, we settle at the money, settle around 32.3%, which is right at the long-term average. If you go back to when these things started trading, that's about where the long-term average is. We bumped up yesterday. We settled at the money at 46.4, so that's a 14.1 volatility increase, and that's a big bump. However, it's not the high of the year. I mean, the high of the year was on January 2nd when we were above 50%. So, and that was coming off that sharp decline in price. So, that's where we are. The other significant thing is that October options expire today. So I calculated roughly 100,000 just call options that went into the money over the weekend. And I'd say about maybe 75% of those were probably expected to expire worthless. So that was kind of a shock. And it's hard to say, everybody did this, everybody did that, because you come in on Monday and you're short a call option. Now it's, the price is in your face. You've got to take some action. If you're long that option, it's possible you take the counter action to that. But, it doesn't always work that way. So it's hard to sort out, everybody's doing this, everybody's doing that. But 100,000 call options all of a sudden became relevant. And again, because they're expiring today, they're going in the money, which means they're going to quickly have an afterlife as a futures contract. They're not going to go off the board quietly. So, and now with the down day, a lot of those options that were going to be turned into futures contracts are now going off worthless. So it's kind of like this light switch going on and off, and it's probably, I'm guessing, and you can't know for sure, it's probably adding to the volatility, not dampening it. So
you would think so. You think that covering caused was, besides the news, do you think that contributed to the big spikes in WTI and obviously Brent too? Spike as people had to take cover.
Yeah, I think I don't want to get the tail wagging the dog. I always focus on the options, and I think that's where it's like living in New York City. You think that's the center of the universe, so you have to step back and say that this is the it's really the tail. But again, this is because it's it's such an extreme move, and because these options are going off the board, it could have added to and the people that really need to do something were the ones that were short options and maybe short without any oil covering it or any futures covering it. So yeah, they had to act quickly, and it may have helped drive the thing up. But if you're short, if you had a short position on, if you were a fund or something like that, you also had to take action. I guess the funds wouldn't be short the front month, but they had to,
they wouldn't be short the front month, but they, their short position has definitely grown over the last,
right.
Over the last few weeks and months.
Yes.
But to just dramatize what you're talking about, Jim, this thing, crude settled at 54.85 on Friday.
Yes.
And the next thing you know, it's opening at 61.48. So all those, if you were short 60, 61, 60,
right, exactly.
That doesn't make for a really happy weekend.
And one thing that's been missing this year are days when you see a strike trade over 10,000 contracts. We had 3 of them, and guess which ones? They were the OX 63, 64s, and 65s. They're all traded over 10,000. And the OX 70 call was about 9,500. So
wow.
Yeah, that's exactly. So you had people scrambling, and now we're going the other way, or sort of,
right?
At least for the short term.
I'm sure there's some regret on their actions, but they had to do what they had to do.
Yes, and one other thing, Andy, when we look at the spread options, there was a big trade took place in the Novi Dees 50 call, about over 16,000 traded. That's a big number. And open interest declined by 15,000. So those 50 calls, the Novi D spread moved up by about 44 cents, if my math is correct. So that pushed that call in the money, and somebody took, looks like somebody liquidated there. It's a buyer and a seller liquidating. So it's, right. Again, it's hard to attach who did what, but I'm guessing that it was the person that owned the call said, "Hey, this thing's in the money."
Right.
Thank you very much.
Thank you, whoever shot those missiles off.
Yes, exactly. So
just saved
right.
Millions of dollars.
So so that's and the final thing I'd say is there was a big volume, obviously 485,000 roughly. That's not the biggest. That's probably again, I don't find the exchange doesn't put the record numbers up anywhere, or at least I can't find them. But by my eyeballing, it's probably the 4th or 5th record volume day. And what was missing was the put volume. So we had about 340,000 calls trade. Obviously, they're the ones that were going in the money a lot. And the puts traded about 146,000. So that's a good number. So if you're, some of that could have been hedging, people taking advantage, which now kind of leads us to say, what do you think the U.S. producer response is going to be off of this spike?
Well, I think that yesterday the Cal 20 got up over $55, 50, and might even have gotten up over 56 on a print. Who knows where it was actually trading? But one would expect that, or one would hope actually that the U.S. producer was in there hedging, either using futures or some option some option strategy, because 55 for some producers who have really been there's been a lot of talk about producers under severe stress, either because of debt or so some producers going out. If they took advantage of this rally, there's some existential risk that they can eliminate. So one would hope, and from what I heard, there was some pretty good hedging in the back months. And Jim, I think that's the way to go.
Yeah.
I mean, it's particularly if you're looking at any existential risk, right?
Right.
And almost certainly they're not. Given what the given the news, I'm sure that they certainly weren't hedging all their everything for all their production. That wouldn't be prudent.
No.
But I think you have to.
Right. And also buying puts, even though they're more, volatility soars, but still as a producer, that's not what you're looking at. You're looking at strike price, and then how much is the insurance? What's your effective selling price should the market come off? So yeah, I mean, it just makes a lot of sense to do that. Which I guess the question is, we've already the big three monthly oil reports have non-OPEC production increasing by quite a bit.
Right.
Does this spike add to it, or does it just give producers a better price for the same oil they're going to produce anyway?
That's that's always. They probably, some of them will be able to add to it, but at least they can look their banker and their investors in the eye and say, hey, we're getting $55 for this. That works for us.
Right.
We protected our profit margin, and again, that's the beauty of being able to hedge. And if this explodes higher, they'll presumably have some more bullets, and their bankers and investors will be even happier. But in terms of U.S. production, the short-term energy outlook is very interesting, Jim.
Yeah.
Right now, I think we're at about 12.4. I think was last week's number, if I'm not mistaken, or right around there. They have in the short-term energy outlook, they've got September production expected, or this month's production expected to be 12.55, October 12.58. Then it jumps in November to 12.85, and December 12.92. And next January, almost, we're looking at over 13 million barrels a day, or up like 600,000 from now. Those are big numbers.
Is that like production that's been held back due to pipeline constraints, or is it just we keep producing?
Certainly, yes. I think the pipeline constraints, which are now, as we head into the end of 19 and into 20, there'll be enough pipeline capacity to move barrels from Permian to the Gulf Coast, as evidenced by, the Midland differentials, Jim, are like, they're trading around unchanged versus, what were they, like 20 under or something?
Yeah,
something unbelievable
yes.
A couple of years ago.
Right.
So, yeah, I think it is the pipeline. Plus, there is certainly, we look at all the drilled, the DUCs, the drilled but uncompleted wells,
Yes.
maybe these higher prices, will bring some more volume in. But this was volume that at least the EIA, I don't think, I think other people, including us actually, I don't think it's going to be that high, have modeled something lower than this. But, that's clearly out in the market. Hey, this number is going up, is going up pretty radically anyway. And this obviously came, was before the Saudi spike. This short-term energy outlook came out last week.
Early last week, yeah.
Yeah, so we're due to increase production, and as you said, the other non-OPEC producers are, should, including in addition to the U.S., all the big three have outlined growth in Brazil, which actually may happen, Jim.
I know.
It's beginning to happen.
I know we've been teasing Brazil for a while.
I know, you and I are, are always skeptical, but
what was interesting to me, Andy, was to see that in the IEA monthly, they talked about countries that are producing more than is allowed under the agreement, and Nigeria was one of them. And I said,
right.
I haven't seen that in a while.
Haven't seen that in a while. Yeah, they've had some gains of late.
Yeah.
Also, there's a couple of big fields coming out of Norway that may get up to, they're talking about 600,000 barrels a day next year. So
sure, that's not a wind farm, Andy.
You got me on that one, Jim.
Okay, I'm sorry. I thought they were divesting out of oil. I get
they would like to. I think that, yeah. I think. Well, I think they're getting out. I think isn't their fund divesting out of oil?
It's the revenues are coming in from the fossil fuels, but they won't go out that way. I don't know. Anyway, I'm getting snarky here.
Yeah, you're definitely getting snarky. But
talk about the what these guys have in for their expected stock builds going. So I keep thinking we have a lot more time left in this year, but it's already
no, we don't. Where it looks as though, let's assume for this conversation that there isn't, that Saudi's going to be up in 2 or 3 weeks, and that's a big assumption. That we're going to have to rework a lot of our numbers based on where those, where they come in at. So it looks as though third quarter, according to the big three, and also, what we're looking at, I think we're going to draw in second half of 19. It looks as though we're going to draw about 400 to 500,000 barrels a day, which basically makes up for the builds that we had in the first half of the year of about 5 to 700,000 barrels a day. So net, maybe we'll build on the year, but the next, actually we're almost through the third quarter, but fourth quarter, it also looks as though, we will be drawing. But then you run into next year where, the IEA has us at 28.5 demand for OPEC crude. I think it's going to be higher at around 28.8, but they're producing 29.8. So you're looking at the first half looks ugly. It looks like there could be 1 million barrels a day stock build.
Right.
We'll see. Again, we'll see what happened. I marked demand down. Everyone else has as well. But
yeah, can I stop you there for a second? And do you think these guys have stopped the market? I mean, the EIA has marked down demand by 100,000 this month for 2019. They have a plus 0.9 growth, and then for 2020 they have plus 1.4. So, I mean, what do you think? I mean, do you think we've stopped?
Yeah, I think the IEA is still, the EIA and the IEA incredibly still is looking at a big time second half 19. They're looking up 1.6 for second half 19. I don't recall what their, I think they're 1.3 million barrels a day growth for 2020. And what they're banking on is petrochemicals,
right.
They really think that petrochemical demand is going to surge. There could be some, we'll see what happens with diesel, with this IMO 2020 staring us in the face. We'll actually see what happens, if there's any change on that, given what, the Saudi news is here and how that develops. Maybe that's going to be, maybe that'll be postponed for a quarter. Just it's possible, not
Right.
probable, but certainly possible. So it looks as though, I think that a lot of these, we heard Rick Perry and we heard Fadi Birol of the IEA talk about that there was ample, this ample inventory. The reality is, I wouldn't call it ample. I'd call it like average. It looks as though at the end of right now, if we look at the end of second quarter, if you take industry stocks and you take crude, and you take government stocks, we're at 93 days, both of them combined, and the 4-year average is 95 days supply. So, we're I wouldn't say we're in any glut situation.
Right.
And which is evidenced by the, you could look at the Brent curve and you're not in any, we're not in any glut situation.
So the market is looking, obviously they're feeling the draws currently, and they're looking ahead and seeing decent sized builds, right?
Right.
So when you look at the curve, you're getting dollar of backwardation in some of the months in 2020. Is that what do you think about that?
I think that doesn't make any sense, because you're looking at, it looks as though, again, all these numbers have to come through in terms of the production. I'm talking about U.S. now. Production has to boom, and imports, exports, runs, et cetera. But just using the EIA data, and we use that, I like looking at it because I remember that we went to a presentation and one of the EIA guys was talking about his model.
Oh yeah.
That blew us both away, I thought. It was
that was just great.
Really on it,
Yeah,
I used to poo them, and
listen,
now I was like, wow.
It's a tough job,
Oh, tell me about it. Right.
I teased the IEA monthly when I guess it was in 2016. They came out with a report that said the world was awash in oil, and they picked the bottom within a couple of weeks. But
right,
but the thing is, people look at those numbers and say, like OPEC will look at those numbers and say, hey, we have to do something. Or, the market will react.
Right. Oh yeah, the market definitely reacts.
So it's.
But getting back to the point.
Yes.
So what the EIA has, they have stocks building up to U.S. crude stocks building up to 494 million barrels in May of 2020, which would be 10 million over, where we are this year, and way above the 5-year average, even with runs. They have high runs, so. We're up over 500 million, which, would not really be a backwardated situation,
Right,
but I guess with the market, but the curve is backwardated. And I guess the market is anticipating, this new pipeline capacity coming and Cushing draining,
right.
But it's possible the Gulf, things back up because the Gulf Coast gets constipated.
Yes. That's it. Yeah. I mean, I guess the market's saying we're going to look more like a Brent market than a WTI stranded oil market, I guess.
Right.
So
yeah,
that'll be interesting to see how that plays out.
Yeah. Now, I'm not sure I would sell the front and buy the back right now.
Yeah, of course.
So, I think it's the play, but you can't, it's tough to do, because this clearly, we've got more to this episode, right, Jim? I mean,
it's still unfolding. We have
unfolding. We have the, what's the Saudi reaction going to be?
Right.
I don't. Is it going to be military? Are we going to really is there a conflagration in the future? I don't,
Yeah, I guess whatever the Saudis do, it'll probably be in an area that doesn't produce oil right now. If it, if they, this is probably not a good idea to start thinking of these scenarios, but because it'll, there's just a lot that could happen. It's the retaliation from the retaliation. When once they retaliate, then what happens? Then the Saudi oil fields are open for attack again.
Right.
Exactly.
And again, it's pretty hard to handicap, given the players in the region.
So let's take a little turn here and talk about product demand. Can you talk about gasoline and then diesel, and maybe fold that into the IMO?
Well, the diesel, yeah.
It looks like
gasoline. I mean, gasoline, as we've been really talking about all year, has been, U.S. gasoline demand is unchanged, plus or minus like 0.5%. And I don't, even with lower, maybe we're getting a little bump up with lower pump prices, but it's not going to be, it doesn't look like it's going to be significant through the end of the year. I think on which is really, as I think we've talked about this before, Jim, but when we get the bearish economic news or the bearish Chinese trade front news, it's gasoline that always gets killed, right?
PMIs, yeah.
And they talk about, well, the demand for gasoline, the demand for industrial fuels is going to be poor because of this. It's going to be unchanged. That's what it is.
Right.
But yet the market can go down 10 cents on, on not nonsense, but, I guess on sentiment.
Yeah.
Globally, there is some Indian demand is not that great. Chinese demand has been okay for gasoline. I think that, pump prices are lower than last year. They probably, they are going to go up here depending on where crude is. Gasoline was up 20 cents yesterday. I think the diesel is certainly the more interesting product. Demand there it hasn't been great. It really has not been great. And that has been a direct reflection of some of the economic news, and particularly on the manufacturing front.
Right.
There it does make sense if diesel gets hit. I guess it makes sense that gasoline gets hit, but probably not to the extent that that it does. Now, what in terms of the IMO, what we're not looking for, but the government is looking for, again, getting back to the EIA, they think that distillate production is going to really surge this year to make a lighter fuel for the IMO. In fact, this is an unbelievable number, and I don't believe this number, Jim. They have April and May diesel production or distillate production at 5.85 million barrels a day in the U.S. Last year, it was 5.18. So they're looking for, like 600,000 or 700,000 barrels a day increase on diesel production, and of course a concomitant increase on diesel exports. With those exports helping to may or may not help to feed the IMO 2020 demand increase. It's pretty interesting what they did. I think on this one.
Yeah,
I think they're full of it. After I just went through I love the EIA's model. But,
yes.
This I think is is a disagreement. They don't see demand spikes on diesel, basis the IMO. Remember, U.S. ports, of course, are for Jones tankers.
Right.
mostly. It's unlikely that VLCC is going to fuel up in the U.S. They'll more likely Caribbean or somewhere else. It'd be too expensive, I think.
So this is a difficult question, but do you want to give us a sense of what you're looking for going forward? I mean, in terms of price.
That is, yeah, sure. As we said, we don't really think this is, or I don't think this is over. Obviously,
Right.
despite whatever the Saudis say, there's definitely, we have to see how quickly they can get this back up.
Right.
If it's 2 or 3 weeks, yeah, it'll be less of a deal. If it goes forward, then yeah, it's important because, as we mentioned, there's a shortfall in the market for third quarter and a little bit for fourth quarter. That'll be made up by the by some added production elsewhere and probably an SPR release or an IEA release, again depending,
yeah.
Depending, I think. But and then we've got the we don't know what the response is going to be either.
Which response you mean?
The Saudi
right,
response,
right.
Like the geopolitical stuff.
Yeah, I was thinking demand response.
Well, that too.
To higher prices, yeah.
Right, that too.
Yeah.
So, I think the market's been trading around 55, the WTI market, for a while here. That clearly is going to move up. There's got to be a risk premium because there's more risk.
Right.
There's even if the Saudis get these barrels out quick, it isn't as though they're, particularly happy about being attacked by the Iranians a few weeks before their IPO,
right,
with the UN. So, there's got to be a risk premium, whether it's $5, $10, I'm not sure. So, I think if the market trends back into the, 55, 57 area, that's probably a good area of support.
And you also like diesel to outperform gasoline in terms of
price? Diesel
should,
It
right?
wouldn't be running. Yeah, the Saudis would probably need diesel. It wouldn't be running and putting on diesel, heat to gas spreads. But
no, never. But cracks as well. You wouldn't put those
diesel
on.
Cracks should do. Yeah, we're going into turnarounds also. So
all right. Yeah.
Diesel cracks should do pretty well.
So let's think about news. So you're looking. You obviously we're going to look at the Saudi developments very closely, but then you're going to be looking for what U.S. production to see if that.
Yeah, to see if that comes to where the EIA says in fourth quarter. Obviously all the geopolitical stuff.
And that those numbers will show up in the EIA weeklies to start.
Right.
Yeah.
Right. I mean, they're pretty ambitious targets, I think.
Yeah.
And then obviously it's all going to be front page stuff and tweets.
Yeah. Yes.
Now, how would you play this? Let's. What do you think on options? What?
Well, yeah. I mean, listen. You're talking about a 46.5 vol. I'm not a big fan of selling options in the normal market. So now we've got a bid in there, but that's probably a pretty good price for options based on what's going on. But do you have a strong price view? I don't. If I had a strong price view that it was going to go down, I'd be buying puts. If it was that it was going to go up, I'd be buying calls. That's basically, but I'd have to eyeball it and say, okay, I'm paying this amount of money. I think the price is going to go here, and kind of not worry about paying a high vol number in that respect. And then 2 months from now, we could be at the same price, and everything expires worthless. But at least from the get-go how much you are risking, and I think that's why they're expensive, because it's a volatile situation. And one other thing is that we look at our option models to back into these volatility numbers, and they for years back in the 80s when I was teaching classes, we'd always point out, the option models. One of the assumptions is that prices trade continuously. So every, the price, and we saw Monday, we gapped a few dollars. So, it's, we use the models for analysis, but we don't kind of live and die by them.
Some people try to.
Well, we've in the past.
That's where they get in trouble, right?
Yeah, people have blown up big time. Yeah, going back to the old volume investor days was the first. I think they were the originals. One of them. Anyway, anything else you want to add, Andy, to this market? And be careful out there. I mean,
yeah, definitely. That's a be careful out there for sure.
Yeah.
Because as any headline or as I said, any tweet, you can change the whole dynamic.
Right. Yeah. And when you say tweet, you're talking about our president.
Of course.
We didn't cover that too much, but that's kind of like assumed.
Right.
Yeah. Okay. So this is Jim Colburn, Commodity Research Group.com. Check us out. And I'm with Andy Lebow, and we'll see you next month.
Okay. Thanks, Jim.
Thanks, Andy. Talk to you later.